first rates on your screen will just start coming up. 140 points up for the Nifty. For the Sensex, it's a 400 point up, 500 point nearly uptick for the Sensex. So the bulls today are really calling the shots, so to speak. So will the bears become scared? That is the point. So far it's looking good, completely in favor of the bulls. A percent higher, almost a percent higher for the Nifty. The bank Nifty almost 3/4% higher, and for the Sensex also things are nicely really coasting along. Now let's look at the broader tone of the banking index. The banking index on Wednesday appreciated smartly and very smartly. The bank Nifty up 1%, Union Bank, UCO Bank, Bank of India, Bank of Baroda, SBI, some of these stocks literally did cartwheels. None of the banks are showing any large point of excitement. Union Bank is flat. That's, UCO Bank is flat. So the excitement of Wednesday is not translated into big gains. Where is Reliance? That one holds the key. And then Adani group of names, which in a sense are important. So today markets are moving higher despite very little support coming from banks per se. And Reliance is the one which is really the bright star, so to speak, the real engine stock, at least in the first 1 minute of trade.
A couple of defense stocks as well are going to be in focus. We told you about BEL. It's bagged an order of more than 8,000 crore rupees from the Indian Armed Forces. That stock has gapped up 7.25% this morning. What a move on this one. There's also Cochin Shipyard too, which has signed a contract worth about 9,805 crore rupees from the Defence Ministry. Cochin Shipyard as well, it's a 7.25% move coming in, no less. And then Bharat Dynamics as well, a contract worth 8,161 crore rupees from the Defence Ministry for Akash weapon systems. So sizable orders coming in for both BEL, Cochin Shipyard, as well as what we told you for BEL. And this is that one segment which is holding out just so smartly in trade. Couple of pharma names as well which are in focus. And first, Lupin, negative news on this one. The US FDA has issued Form 43 with 10 observations for its Pithampur Unit 2. That stock has gapped down 3% right now. There's also Piramal Pharma though, positive news coming in here. And so is the case for Oro as well as Cipla, which have formed an agreement with UN's MPP for a long-acting injectable. So all of these stocks are holding out well in the green as we speak right now. Reliance, of course, Nikunj highlighted. That's one stock which is in focus and holding out okay. There's Maharashtra Seamless as well, a sizable 537 crore rupee order from ONGC to supply seamless casing pipes. There's RVNL, which has got a letter of intent from Rail Ministry for manufacturing of 200 Vande Bharat train sets at 120 crore rupees per set. RVNL holding up 1.6% as we speak right now in trade. Viatech Vabag as well. They've bagged an overseas order and a sizable one at that at 4,400 crore rupees. Viatech Vabag gaps up 5.25% as we speak right now in trade. So not bad at all. It's holding out well. There's the Shriram Properties Brock deal as well coming in, 9.25% higher for this particular stock. Defense stocks looking okay, and the Nifty, Kunal, holding out a good 1%. Not bad at all.
I think it's a very good move for the index, and in fact, if we actually close 1% higher or 1% or so higher, then we would close the month of March on a calendar basis on an absolutely flat note. So from being a point where we were down some 3%, 2.5% for the index, I think this could be a good end of the month recovery for the Nifty, and this would also probably end the 3 months of consecutive correction for the index. So something very, very important. No, this could have been the 4th month. So this.
Yeah, we almost. Unless you go up by 3% today, it will be the 4th month, right?
So yeah. So if you close above 1%, then we are ending the 3 month of consecutive downfall. So the opening trade which I would look to trade would be on Manappuram Finance. That's a stock which I think has done exceptionally well in the last 1 or 2 weeks, from 109 to 120 plus levels. The stock closed on Wednesday. So that's a stock which I would look to buy.
Right. Naresh, what are the first trades that you are executing, considering it's a decent start?
So waiting for a dip on SBI, continued like the stock. The stock has opened up 1%. Closer to 518, 520 would be adding on to more positions here.
Okay, that's SBI. That's the buy call coming in from Naresh. And Kunal as well just highlighted what are his buy strategies too. In the meantime, just taking stock of what some of the other buzzers are looking like in trade, just going to refresh my screen. BEL, of course, is holding out right on top. Reliance has moved 2% in trade. Techem is holding out 2% as we speak right now. Bandhan Bank has made a good comeback, 2.5% higher nearly. And Adani names as well continue to support the market. So Adani Enterprises too holding up 3.5% as we speak right now.
Mahesh Indulkar joins us now, Head of Research and Managing Director with Jefferies. Mahesh, good morning. Thank you for joining us. So Mahesh, all the global and local brokerages are now saying that it's time to buy India. Is it really time to buy India?
Sorry, I think the valuations have clearly come back to a more palatable level. We are trading at 17 times 1 year forward earnings, and this is in line with a historical average. In fact, if we look at the valuation comparison with the other emerging markets and other Asianics, Japan kind of markets, that's also in line with the historical averages. So I think the valuations have come down to back to historical average levels. The second point is that the macro situation also, from an India perspective, is also actually reasonably okay. I mean, we are looking at the rate cycle peaking out. We are also looking at the current account deficit for this year and also for the next year is turning out to be much lesser than what was initially feared. The oil prices have also corrected. The commodities are down. So in many ways, I would say one should be looking at investing in the markets from a longer term perspective. Yes, from a shorter term perspective, things are still quite confusing. Especially from the global perspective, there are likely to be some more negative news coming out from elsewhere in the world. But I guess long term investors should be adding here.
Mahesh, so are we in for a slow second half and a good second half?
Yeah, I think it looks like, because the near term, probably is still a bit sketchy, for the markets, and as I mentioned, more because of the global developments, as such. So second half should definitely be, far better. And yeah, I mean, we are not going to be seeing like supernormal returns, but clearly what has changed over the last, I would say a few months, or let's say like 1 year or so, is that the central bankers all over the world have kind of stopped printing money. They've started adjusting their balance sheet. The rates have gone up. So in many ways, the easy environment for equity investments that we had seen over, let's say, from 2010 to 2020 isn't really there anymore. So we have to be cognizant, of that fact. Yeah, but having said that, I think now seems to be the time to start buying.
I was just wondering what's going to be the construct of the market, say, in the next 6 months to come? Because what one has seen is that there's been a stark underperformance from not just blue chips, but individual sectors, high weightage. And I'm not talking about the Adani group here, but I'm talking about something as large as banks and something as key as banks. Where do you think the leadership and underperformance is going to come in from, say, in the next 6 to 12 months?
See, what has happened with the banking sector is also that, in general, over the last 1.5 years, we've seen heavy selling from foreign institutional investors. And we've seen selling almost to the tune of around $30 billion, right? And what we've seen historically also is that when the foreign institutional investors sell, the banking sector typically ends up underperforming. But my sense now is that the foreign investor positioning in India is very, very light. In fact, I will go to the extent that to say that it is at the lightest level that I have ever seen in the last 10 years. Several large funds that we interact with are underweight on India. And the reason for them to go underweight over the last few quarters has been the extreme valuations. But as I mentioned, those things are correcting as we speak. So my sense is that from here on, the foreign flows should be on the positive side and not on the negative side. And that should primarily be one of the driving forces for the banking and financial sector, which is also incidentally the sector where the valuations have corrected quite significantly. They are trading at much below their last 10-year averages. So looks pretty attractive. Since you asked the question about the construct of the market, I clearly believe that it's the domestic cyclicals that should do better, which include banks, NBFCs. I would also say, industrials. Um, in the near term, I would also be looking to own consumer staples as well. I think the concerns on monsoon being weak and therefore rural demand getting impacted, etc., to my mind, are overdone. We have to keep in mind that rural is not agriculture and vice versa. Rural or the bottom of the pyramid is far bigger than agriculture. I mean, agri GDP is about 16-17% of total. Rural is about 40-45%. So there is much more to the bottom of the pyramid demand than agriculture. And I think the non-agri segment, is basically driven by the other services, the construction services, construction sector, seeing pretty strong trends and pretty robust trend both on the infra side as well as the housing construction side as well. So yeah, so that's the reason why I would be adding staples here as well. And by and large, I still believe that the outlook for the global growth is has got worsened, and the domestic growth outlook is looking far better. So would look to overweight the domestic sectors rather than outward-looking sectors.
Trade already at play, Mahesh. Just think about it. Banks have done well in last 1 year. Cyclicals have done well in last 1 year. Industrials have done last well in 1 year. Stocks like ABB, Siemens are trading at P multiples, which are almost nearing P multiples of consumer names now. So my point is that while there is a very strong merit in the case what you are making out, that is something, haven't markets already factored that in?
See, Nikunj, I am talking about very long-term trends here. I mean, if you look at the markets in the, let's say, the previous decade of 2010 to 2020, we had a pretty long history of those 10 years where many of the consumer-oriented sectors and the so-called defensive sectors actually did very well. And that was because the gross fixed capital formation, the GFCF, or what in more palatable terms called as the investment cycle, that has been running weak. Now that trend has changed. The investment cycle has started showing signs of pickup, led by the housing sector, and I think it's a trend that will continue over the next several years. So yes, what you say, so what you're saying is right. That to some extent, we've seen some of these things playing out already over the last 6 to 12 months. But one should be focusing on longer term trends here. And my sense is that the last decade was the decade of the defensive sectors, the consumption sectors, etc. This decade is going to be for the investment oriented sectors like industrials, property, banks, etc. And 6 months or 1 year of performance should not deter us from moving away from there.
Okay. Mahesh, will it get bad for IT before it gets better, or bad will remain bad and IT will remain low?
See, the thing is, I do get this question, and many of the investors are inclined to add. And IT has actually done. I mean, IT stocks have actually done quite well over the last 3 to 4 months. Let's say by the last 1 month. But my sense is that the news flow over there is going to remain choppy, and you will go through these cycles of valuation driven buying that will be coming in, but then there will be some fundamental negative in the sense that some layoffs in the US or concerns on the US corporate profit growth, etc., will keep on emerging. So I think it's a sector that will remain range bound. There are obviously some very high quality names in that sector, but we still remain underweight there.
Whereas the other thing one is wondering is what happens to foreign institutional flows. Do they pick up anytime soon or not? Because we've seen as to how consistent FII selling has been in the last 3 months, year to date, in fact. And the money is clearly moving out to either other emerging markets or back to US equities. What would it take for the flows to return back to India?
Yeah, Aisha. So, as I mentioned, the foreign investor positioning in India at this point in time is at one of the lowest levels that we have seen. And in fact, I can tell you that, close to 100 plus investors that, I've interacted with over the last few months, more than half of those have been underweight on India. This is something that has never happened. And so in that, to that extent, I would say that the weightage correction in the foreign portfolios as regards their India weightage is concerned has largely been done, and from here on, it's actually a case for the India weightings to go up in foreign portfolios. So I would expect the foreign flows to be positive. Obviously, uh, one of the other factors that we need to keep in mind is what's happening in the global risk on risk off sentiment. If we see a few more negative news flow coming up in the financial sector in US or Europe, maybe it will put some near-term pressure on foreign flows, but that's more global. But from the India standpoint, I think the relative flows into India should be improving from here on.
Mahesh, what we've read and what we've analyzed over the years are these two very famous trends. Weakness in dollar index is always good news for commodities and emerging markets. That has not played out so far. And second, in a rising interest rate environment, in the first cycle, equity markets, they always tend to go higher. That has also not played out this time. So why have these two mega trends, which are the trends of the decade, which everybody talks about, have not really played themselves out this time?
A very fair question, Nikunj. And I must say that the macro environment globally has been quite topsy-turvy. I mean, say like a month or month and a half ago, the global consensus was around the US rates remaining higher for longer, and there were some odd voices or noises coming towards the US Fed raising the rates up to even 5.5 to 6% as well. And now, in the last 1 month, things have changed quite a lot. And the consensus is now talking about a rate cut by the Fed as early as July, and possibility of more rate cuts during the remaining part of the year. So the point I'm trying to make here is that the global macro has been extremely volatile, and there have been some of those things which you would normally expect that haven't really happened. I mean, like for from sort of that point of view, what happened in most part of CY22. While the US rates went up from close to 0% to almost 4.5%. Ideally, that would be the time when the P multiples all across the world should have corrected, and those did, but to a very small extent. So many of those, historically, proven trends haven't really played out, and clearly it goes to show the, the risks, of the volatility in the global macroeconomic forecasting. So that's the reason, why I say that, if we just get down, to the fundamentals, I, do believe, strength in the, in the Indian economy. I do see strength in the investment-oriented sectors and, the parameters around that. So yes, there could be some ups and downs, but generally speaking, I believe this decade is going to be the decade of investment-oriented sectors like banks, NBFC, industrials, property that will deliver better returns than the market.
Mahesh, if interest rates come down, which they will, now we are debating this quarter or next quarter, do you think there is merit in going back to growth stocks, whether it is a Zomato or whether it is a Paytm? Ultimately, interest rates act like a pivot for these valuations. Could there be a comeback in the fintech and consumer tech stocks?
Yeah, I think some of these tech stocks are looking interesting, and especially the long-term growth story is there for sure. But at the same time, we also have to keep in mind what's happening in the private equity world globally. And I think that remains one of the risk factors for the global tech stocks, not just the Indian ones, but also the global tech stocks as well. So I think from a longer term perspective, maybe some of these names make sense. But our view is that we could be getting into volatile times from a near term perspective, as far as that overall the tech industry grows. Obviously some of those names could be looking interesting, but I'm just commenting on the overall sector at this point in time.
Great to chat with you today. Thank you so much for taking the time out and joining in.
Thank you very much.
Okay, let's just take stock of where the market has settled in at. It's sure has been a good start to this Friday morning, and we continue to hold out. We're nicely clinging on to that 17,350 level in the Nifty futures. Reliance is the one which is sitting top of the pack. 2.5% is the kind of move that you're seeing on Reliance alone. And that's single-handedly supporting the index right now. Other heavies like an ICICI Bank holding up 2%. SBI is up 1.25%. Axis Bank as well as Infosys are your other big winners in trade. And not a bad move coming in from some of the technology bellwethers as well. And HCL Technologies, TechM are both looking up as well. Good breadth as well. A solid count of 163 within the F&O. To just about 28, standing to the declines. BEL, Balrampur Chini, Hindustan Aeronautics, Interglobe Aviation, Bandhan Bank, these are all your big winners in trade. But let's hear out from Saurabh Mukherjee of Marcellus Investment Managers. He's doubled his position in 2 pharma majors and has added a couple of names to his fund portfolio. Let's find out which ones they are.
Divi's case, if you look at the business today compared to where they were pre-COVID, the business is around 30% larger. Revenues are 30% larger. So strip out Molnupiravir, and even then Divi's is 30% larger. The firm's grown by a third through COVID. They had a gross margin hit in the quarter to December. Our reckoning is much of that will unwind. The raw material cost issues that were taking place in the quarter to December, I think, unwind. There is inventory destocking happening across the pharma industry, across the world. Some of that, I think, will still carry on in the March quarter. I doubt that the March quarter will be a booming quarter. But given that the company's top line has grown steadily over 20 years, has grown steadily even through COVID, stripping out Molnupiravir, as gross margins recover, this business is in good shape. We speak to several of their customers around. Their key customers are the world's 6 largest pharma companies. We speak to them quite regularly. And the view is this company has come out of COVID with their credentials burnished, their credibility is an all-time high, and with Western pharma companies looking to reduce their dependence on China, we see these incredibly well positioned. So through November, December, we doubled our position in Divi's. Coming to Dr. Lal PathLabs, somewhat similar, right? If you look at operating margins, they're higher today than they were before COVID. And this talk about competitive pressure, I think, is a lot of nonsense. If a company is under competitive pressure, you should see that pressure on operating margins. You don't see that here. This company's free cash flows are more than the rest of the pharma, rest of the path lab industry put together. Excluding COVID, business growth is around 12-13%, couple of percentage small lower than what it was before COVID. But I think as we come out of COVID and we get back to our old routine of perhaps not being as hygienic as we were through COVID, as we sort of lose the habit of using sanitizers and washing our hands, I think we'll go back to 13-14% top line growth that Dr. Lal was accustomed to seeing before COVID. So competitive intensity is reducing in the sector as private equity and venture capital funding dries up. And we see Dr. Lal nicely positioned. So July, August, we doubled our stake in Dr. Lal.
Saurabh, where are you putting your incremental money to work apart from the fact that you've doubled positions in a couple of these pharma companies? Which are the spaces or the recent additions that you have made to your portfolio?
So I think we haven't added Tata Elxsi in our mid-cap portfolio. That was our last big addition. I think you flashed on your screen. We got out of Relaxo and added Tata Elxsi around 3 months ago. The other addition we've made in our financial services portfolio is in the midst of this mayhem around capital gains tax on debt or income tax on debt mutual funds, we've added Prudent Corporate. Prudent is a wealth manager. It's a wealth management platform for the IFA community. We've added that to our Kings of Capital portfolio. We see this space as being very attractive. We think the mutual fund story in India will play out amongst the mass affluents. What Prudent has done is built a platform which has 25,000 IFAs The IFAs bring in mutual fund business, they bring in insurance business, and Prudent gets a slice of that action. So we've added Prudent in our Kings of Capital portfolio, and we'll monitor Prudent over the coming months and see whether it merits additions in any other part of Marcellus's investment.
Back with the market right here on ET Now, and holding out quite smartly actually this Friday morning, the last day of the financial year. And excuse me, we're almost on our way actually to that 17,400 print for the Nifty futures, just 30 points shy from that level, 17,279 for the Nifty spot right now as we speak. It's a good 1% move coming in, and better a day actually for the broader end of the market as well, wherein the breadth has nicely opened in favor of the advances. Look at Reliance Industries. Let's bring up that intraday graph for Reliance. That stock alone is holding out 3% and contributing maximum to today's Nifty move. 71 points higher, Reliance has jumped up back to that 2300 mark in trade. ICICI Bank holding out solid 2% as we speak right now. There's SBI which is up 1%, HCL Technologies, Hindalco, there's Techem, there's Axis Bank which is up nearly 1.5%, and the Adani group of names as well are supporting the index as we speak. In fact, sectoral leads technology, which is the maximum contributor or the biggest gainer in today's trading session. Next, of course, to realty as well as infrastructure and banking and chemicals. Even within the broader end of the market, it's really all about those defense orders that we saw yesterday. So BEL, HAL, RVNL, these are all stocks which are holding out very, very smartly in trade. Cochin Shipyard as well, which gapped up this morning. All of these stocks holding out very, very smartly. Indigo up 3.5% as we speak. Sugar is clearly back in the fore. Balrampur Chini is looking up by about almost 5% as we speak right now. But I think I can... Okay, let's hear it out then from Mark Mobius from Mobius Capital Partners as to what he's making of the current mood on India.
The good news for India is that exports from Taiwan to India are going up, which is a very significant change, because that means that more and more semiconductor business is going to be flowing into India. And I think, as I mentioned before, this is going to be very positive for India. We're looking to increase as we go forward, but right now we've kept it the same as we've had. So we still have a very positive outlook for India. Well, if you look at our weighting, you'll see that it's much higher than the index because we feel more confident, and we have most of the assets now in terms of China and Taiwan is Taiwan. You look at the biggest allocation is Taiwan and then India. So at the end of the day, we have great confidence in what's happening in Taiwan. And as part of that, what's going to happen in India as India becomes more semiconductor oriented, as more and more manufacturing takes place in India.
Well, it gives me great pleasure to bring on board the man of the moment, SBI Chairman, Mr. Dinesh Khara, to talk about his view on the economy, interest rates, inflation, more importantly, what a great year it's been for State Bank of India. For shareholders of SBI, FY23 will be remembered as a real blowout year in terms of profit and stock outperformance. Mr. Khara, good morning. Thank you for joining us.
Good morning, Nikunj.
Mr. Khara, let's understand the big picture from you. The credit growth what SBI reported for the quarter gone by was in double digit, 17 to 17.5%. Looking at the state of the economy, inflation and global turbulence, are you getting a sense that things for FY24 could slow down?
The year which we are closing today, of course, have witnessed a phenomenal growth in terms of the credit, and as also it has been very broad-based growth. It is not confined to only few sectors. But I think the way the trends are looking like, it is actually quite positive, I would say that. And I would say that the trends which are there in terms of the outstanding proposals which are still being processed, so also the sanctions which you have given and which have yet to be disbursed. So all said and done, I would say that as far as the credit is concerned, there's a very clear visibility of the growth in the coming year too. And if we look at the broader macro, the demand seems to be something which is quite encouraging, and it is both in terms of retail as well as in terms of corporate. The kind of investment commitments which are shown by various private sector entities and also by the government of India in terms of the infrastructure focus which is there for the next financial year, which has been indicated in the budget. So it's about 10 trillion plus as far as the budget itself is concerned, plus 2.4 trillion from the railways. And invariably, the infrastructure spend has got a significant multiplier effect. So I would say that in view of all this, it is, I would say, the year coming in, the financial year 23-24, we expect a fairly good growth opportunities. And I think we are quite hopeful that we'll get to see decent growth in credit too in the next year.
Can I safely say that in terms of credit growth, a number which everybody wants to understand right at the beginning of the year, because it's the most important number for SBI shareholders and for markets per se, you expect the growth momentum of 15 to 17% to continue?
Yeah, I would say that around 14 to 16% is something which I've been maintaining. So I think it should be, we should be in a position to clock growth somewhere around 14-15%.
We have seen a big surge in interest rates, and historically we've always maintained that the first uptick of an interest rate cycle is always beneficial for the banks because deposits, they get repriced slowly. Would you get advantage of that, sir, also in FY24?
Yeah, I expect that we will have a fairly decent advantage which should be accruing to us, because when it comes to our the way our loan book is stacked, about 34% would be in EBLR and 41% in MCLR. And MCLR also is equally spread between 6 months to a year. So there would be, we still have some elbow room for passing on the interest rate. So I think it will give us an opportunity for NIM expansion for some time to come, even if the policy rates stabilizes around where it is. So I think, having said that, I would also like to mention that even in the last year, when we have seen so much of clamor for the deposit by various entities, our cost of deposit would have gone up just about 7 basis points in all. So I think that gives a very clear leverage to us in terms of our ability to generate better NIMs in the coming year too.
Sir, do you see the gap between the deposit growth and the credit growth narrowing down? Because that, in a sense, has been a concern for the banking industry per se.
Yeah, what we have seen is that the deposits are growing at about around in the range of about 10% or so. But at the same time, credit has witnessed a growth of about 15-16% last year. So I think it will, as I was indicating, that we are expecting credit growth of about 14-15% in the coming year. And likewise, we expect that even deposit growth should marginally improve. And having said that, I would also like to mention that our credit deposit ratio, even as of now, if we look at our domestic book only, it would be somewhere around 66-67%. So it actually gives us enough elbow room to really build up our book without really compromising on our cost of resources.
Can I safely connect the dots here, Mr. Khara, and say that SBI margin expansion run will continue?
Yeah, I'm hoping that as the situation stands, we should have opportunity for NIM expansion in the coming financial year too.
Automatically means the magical number which you've achieved for FY23, my sincere compliments for that one, the ROA of 1%. So for FY24, the threshold now becomes 1%. ROA 1% to rahega hi rahega.
Yeah, that will be our effort also. We would like to keep it sustainable ROA of more than 1. And also we'll try to improve our ROE too. So that will be our, I mean, these are the key metrics which I monitor very closely. And of course, I'm quite hopeful that we should be in a position to really do well on these two metrics.
Sir, I distinctly remember on the budget day you came out and you calmed the market about your exposure to Adani Group of companies. Any update on that? Any update in terms of the debt repayment, loan repayment? Is everything as per standard account?
Yeah, everything is standard. They are maintaining their repayment obligations, and what they have indicated. The major challenge, which was apparently seen by the various players in the market, was essentially relating to the loan against shares. And as I sense that they have already repaid the loan against shares, and of course these loan against shares were essentially raised from either from the NBFCs, or they had raised these loans against shares from the international banks. So I think as far as we were concerned, we had not extended any loan against shares, but they are maintaining their repayment obligations, and as far as the cash flows are concerned for all their entities, there is absolutely intact. Rather, there is no challenge whatever is there for the loan book of the banks, as far as this particular group is concerned.
So your exposure to Adani Group of companies was less than 1%, which is well below the threshold limit. Would you be okay to increase your exposure to Adani Group of companies if there is a need arises?
I think for the time being, we'll have to wait and watch as the situation stands. But I believe as of now, they are more into the. I think they have not really approached us for any kind of increase. So it's the question is not there at all. But I'm sure whatever repayment is happening, they are maintaining their repayment schedule. So we will evaluate the proposal as and when it comes, because when it comes to the lending, as far as banks are concerned, we lend against the assets, and also we lend on the basis of the cash flows, which are very evident. So we will make very, very clear assessment, and based upon that, we'll take a call.
Such a brilliant point. I remember Mr. Khara came out and clarified which stemmed the stock fall in Adani Group of companies. I'm just sharing with our viewers that SBI and bankers, they lend against cash flows and against the assets, not against the equity price. So what happens to equity price is secondary market operation, not what something banks are bothered about. So we should not connect the lenders here and assume that what's happening in a group of companies, equity stock valuation will have impact on the stock price per se. But Mr. Khara, there is one concern at a global level which is now coming up, and that concern clearly is surrounding around 81 bonds. How do you see the implications of that would be for banks like SBI?
Well, of course, this concern has been there for quite some time. But what we have witnessed is that last year, apart from the concerns, even there were some valuation norms also which were a cause of concern. But nevertheless, we have observed that for well-managed, well-rated banks, we are getting enough demand for 81. And this year itself, we have raised more than 15,000 crore during the financial year 23. And we have raised it at a very, very competitive pricing. So I think that is a very clear reflection that 81 investors are looking for the quality paper. And once they have got a confidence, they are willing to pick it up too.
Mr. Khara, after the new finance bill, there is a view in the market that money into debt mutual funds will start drying up. And on the margin, that will benefit banks and money will go back to fixed deposits. Now, you understand the mutual fund business, sir, more than anyone else. So, connect the dots for us.
Yeah, I mean, the way I look at it is, when it comes to the duration funds, essentially, where the long-term capital gains was available in case of debt mutual funds, the amount of that, because today the mutual fund industry is around 40 trillion Indian rupees. And out of that, my sense is that the debt fund should be, a debt fund which will have an impact of the long-term capital gains would be somewhere in the range of about 3 to 4 trillion, not more than that. And banking system is about 215 trillion odd. So if we look at the total basket also, it would not be more than 1% of the total banking system deposits. So how much of that will really impact is to be seen. The other aspect I would say is that mutual fund as an asset class is actually a different asset class as compared to the bank deposits. It will have some impact, but it may not have very significant impact, if I may say so. And apart from that, what I have also observed over the years is that it's an initial reaction only. Eventually, everybody recalibrate themselves or their asset allocation based upon the ground realities of the taxation laws of the country. So I think that's why I would really look at this particular aspect of capital gains taxation, long-term capital gain taxation of the debt funds.
So allow me to switch gears completely and talk about the home loan market. Now SBI has been a disruptor there. SBI in a sense now has the highest market share, and SBI has got one of the most commanding rates. Do you see going forward more and more aggressive pricing in the home loan market?
Well, I think it's more of an opportunity which people look at it. But important aspect to be kept in mind is the risk should be rightly priced. The aggression apart, the risk should be rightly priced. So I think there's a very, very clear requirement in terms of understanding and assessing the risk, and also keeping in mind the cost which is required to be incurred for sourcing, for servicing, for processing, and for overall administrative control of such accounts. So I think each entity must look into various cost components and see to it that they are properly loaded. Sacrificing, maybe it's actually the trade-off between the market share and also the earnings, and also the earnings which are risk-free. So I think from that perspective, perhaps the players need to be very mindful. But having said that, we have to keep in mind the ability of the borrowers also to service those loans. So I would say that, on the face of it, it looks like that it is easier to scale up. But the fact of the matter is that if at all one has to maintain the quality, one has to invest well in terms of sourcing, in terms of servicing, in terms of control, oversight. So those are the factors which have to be kept in mind while doing the pricing.
Mr. Kara, a lot of yes and no on what would be State Bank of India's approach towards their investment in Yes Bank.
Well, we have not yet deliberated the subject in the board of the bank. So it would be premature for me to really share my thoughts on this particular subject.
But in general, do you think eventually, it may be not in this meeting, maybe not in this quarter, but eventually down the road, SBI would be looking at exiting their exposure to Yes Bank completely?
See, we have to keep in mind that it's an investment which you have done. So we would be very mindful in terms of ensuring that we derive value out of this investment. So we will be very mindful in terms of how the markets are looking at the offload aspect, and how much we should do so that we don't destroy the economic value of this investment.
Mr. Kara, FY23 was about rising interest rates. It was about corporates repricing their loans. How do you see FY24 moving differently? Because at some point in time, sir, interest rates will peak out, but affordability will be challenged.
Yeah, I think I expect the year 24, the way the inflation trajectory is, I expect that in the year 24 we should see more of stability of the interest rate regime, and of course there is a component of the increase in interest rate and the ability of various entities to absorb this increase in interest rate. But I would say that if you really look at it, the kind of interest rate movement which has happened, and so long as there is an opportunity for the corporates to absorb or to pass it on, so they don't mind borrowing. And that's why, the demand is very, very important factor. If at all there is a demand, then their ability to pass on the interest also is very much there. So I think I expect that considering the demand which is seen in the economy and the kind of visibility of the demand going forward too, uh, the corporates probably feel that it's an opportunity for them, and for that probably increased cost of borrowing is not as much of a deterrent. And we in any case expect that in the coming year there would be more stabilization of interest rate. So I think overall I would say that they would be looking at it as an opportunity to really serve the demand and improve their turnover and improve their profitability too.
Mr. Kara, my next question perhaps may be slightly repetitive in nature, but I can assure you that every time we interact with you, this is one question or one answer which everybody looks forward to, which is that please understand from SBI chairman his view on the credit cycle duration. Do you see this 14 to 16% growth lasting for 2 to 3 years at least?
Well, of course, the kind of growth trajectory which is charted out for the economy, there is, I would say that there is a very, very fair chance of the system to witness this kind of a growth. For the very obvious reasons that, the new growth levers which have come in, they're essentially in terms of, apart from the core sector, which will continue to grow because eventually infrastructure will depend quite a lot on the core sector growth. And that will also create demand for the core sector product. So that is one part of the story. But the other part of the story is that renewable energy, EVs, batteries, and when it comes to the new gen manufacturing, which is essentially in terms of which is induced on account of the PLI, and also on account of the fact that India offers an opportunity for a resilient supply chain. So I think these are some of the factors which gives a very clear indication that we will get to see a decent growth for a foreseeable future. Because as I earlier also I mentioned that, when it comes to infrastructure, it has got a significant multiplier effect. So that is something which will also drive a lot of demand in the economy, which will also, core sector, industrial growth will drive the demand for the consumer goods, will also drive demand for the agriculture. Lot many newer and more advanced agricultural technologies are being adopted in the economy. So I would say that the kind of growth path which you are following as an economy, it will unfold significant opportunity for growth for the banking sector too.
And at what point in time, sir, the NPA problem could surface up? Because, sir, it's a cycle. At the end of the day, banking sector goes through a cycle. At what point in time the cycle becomes red for you?
See, for the cycle, it is very important that there should be the practices in terms of underwriting, practices in terms of control and follow-up. They need to keep pace with the scale of business which banks undertake. So I think the last 2008 crisis and also subsequently 2014 events of AQR have actually helped the banks in strengthening their risk management practices quite a lot. And in the meanwhile, in the ecosystem, there are various developments which have taken place. The bureaus are there, and now with the help of CRILC, there is a very clear visibility of the borrower's behavior across the banking system. So I think that gives a very clear visibility in terms of the quality of the borrower. Apart from that, now there are entities like GST and etc., which gives a very clear visibility in terms of the borrower's activity level. So it is not merely the balance sheet, but it is also secondary validation through such tools also are now available for the banking system. So I think overall all this has helped in terms of strengthening the underwriting practices of the banks.
Okay, that was our exclusive chat with the SBI chairman coming in. In the meantime, let's just take stock of what the market is at, and we're nicely clinging on to the session highs. 160 points higher, it's a 1% gain. We're well above that 17,350 level in trade. So good going. It's Reliance, ICICI Bank, couple of the Adani Group names, metals, and banks as well, which are holding out very, very smartly along with IT. But what's happening within the paint segment, given the kind of move that you are seeing in crude prices of late? Let's try and understand that a bit better. We have with us Abhijit Roy, MD and CEO at Berger Paints, joining in on the show right now. Abhijit, hi, good morning. Always good to have you on ET now. Abhijit, after extended monsoon and early festivities curtailed in third quarter volumes, how is it that business dynamics are playing out right now when it comes to, in particular, the decorative paint segment?
Yeah. So we are back onto the growth path again, at a stronger growth level, almost double-digit growth that you can see, which is going to come in quarter four for almost the entire paint industry, I think.
But Abhijit, the other, of course, big factor has been the correction that one has seen in raw material prices, crude and its derivatives. Have you recouped the lost margins, and will we then see margins shifting above that 15% level very soon?
Yeah, I know. I think you will see that happening, surely, because some amount of it you will get to see it in this quarter itself, and almost everything will come in quarter one. So you will see an improvement, a good improvement this quarter, and a further marginal improvement going forward in quarter one.
Right. Abhijit, with declining input prices, is there a likely, or rather, is it likely to affect pricing in any which way this year? How much of the benefit are you likely to pass on to consumers, and how much percentage will you, hope to retain?
So as of now, if the demand holds up, there is no reason for, unnecessarily looking at trying to reduce the prices. The second reason is that, we hadn't been able to pass on the full price increases because the price increase was so huge that it was difficult to pass on, the entire thing on to consumers at that stage. So I don't see it happening immediately. Of course, if the prices further go down, then we will have to take a look at that.
Right. Abhijit, the other thing I wanted to understand is the demand dynamics right now. While the El Nino impact may actually lead to a delayed monsoon, which could then benefit paint demand, on the other hand, it may also impact rural growth. What is your sense on how things are likely to shape up on ground? Because I guess, you would be best positioned to really give us a view on the same.
No, you are right, because initially it may help us, in the sense that normally in the monsoon season, paint demand tends to go down, and, post-monsoon it tends to pick up. But if the monsoon is bad, so initially we may gain, but then rural demand might get impacted, and that's not a good story to have. So we'll have to wait and see. This still remains, a question mark as to what will be the impact and how much of it will impact, the rural demand has to be seen. Depends on the El Nino and the severity of it. So we await that, and we will take a call only in July, August when we know what has happened actually.
Sure. Abhijit, the other thing is the expansions that you've planned, especially in Odisha. Is it expected to be as big as Uttar Pradesh Sandila plant going forward? And what kind of levels of investment are we looking at with this capex round?
No, so we plan out, as per our requirement. As of now, what demand we have, I think, the Sandila plant will be able to cater to that for the next 2 to 3 years. We have an industrial plant which we will be putting up in Panagar in West Bengal, and a possible plant in Orissa, very soon. The scale of that Orissa plant will be similar to that of the Sandila plant, but in phases. So it will not happen in one first phase itself. It will probably happen in 2 phases, and we will, ramp up as and when the demand keeps going up.
The other thing, Abhijit, on capacities that you're coming out with, and an extension to what you just highlighted, are they enough to tackle against impending competition from Grasim's entry as well now in the segment, and the entire sector becoming so increasingly competitive, and the expansion plans by other players? Are you then planning on expanding further, other than the current plans that you have?
No, we don't. We basically look at what our demand is and what our supply situation is. I don't think we, as far as capacity expansion is concerned, we look at competition and try to do something there. I believe that based on what we do as a typically a 3 to 5 year projections internally, when we see that we are going to run out of capacity, going by the optimistic projection that we have, we start putting up capacity on our own. So I don't see that happening immediately. We will carry on with our type of expansion that we normally do in steps.
I want to go back to that very basic question. And good morning. It's so good to connect with you, Nikunj here.
Morning, Nikunj.
What will be the impact of Birlas entering the paint market?
Well, it's obviously there will be some impact, right? There will be some amount of, possibly we are growing, say at on a CAGR basis. If you take 20 years, we are growing at 14% odd. Under normal circumstances, that growth rate possibly will come down, in a particular year. Say 10-11% is where it will settle down at. If we do nothing, if we do on our some other activities of our own, maybe we will able to restore back our growth levels, and we won't have any impact as far as the revenue growth is concerned. On the profit front, there will again be some competition, probably at the lower end of the spectrum, which we will have to ensure that we make it up through other means of selling more of premium and luxury products and cutting costs wherever it is possible. So I don't see any major impact happening. Minor impacts, yes, plus minus, and that's a short term skirmish which might happen in the marketplace.
You are going to be completing 100 years. Is it true?
That's right, December 23.
Shareholders, when it comes to 25 years, 50 years, 100 years, they get a lot of benefits, bonuses.
Yes.
What should your shareholders expect?
Hopefully something coming up.
Sorry?
There might be something coming up. When we decide on it, we will of course let you know.
Normally it's bonus, buybacks.
So it will depend. We will have to decide on that. We haven't made up our mind yet.
Is there a reason why every time I interact with you, there is a painting at the back?
No, so there should be. We are a paint company at the end of the day.
I'm just going to wrap it up with one final question. When I analyze the paint sector in India, the real big moment came when the paints, the so-called limestone walls of India, at least in rural India and urban India, they started getting painted, and that really gave this industry a very large growth per se. Has that migration of unorganized to organized, or the Chuna wall, if I may use the Hindi word Chuna wall to paint wall, is that big trend over?
So there are three things happening, Nikunj. One, of course, the urbanization continues. It's still at a very low level of 33-34% in India. And a lot of people are migrating still into the towns and cities, and new houses are coming up. First time painting, and after every 5-6 years again painting. So that trend is likely to continue for the next 8 to 10 years. So that growth will not be impacted so much. The second is the premiumization, which is happening as the money flow improves, as people's earnings goes up. They tend to move upwards the ladder. So that's another gain which is there for the paint industry, and that's going to continue also. The third opportunity which is opening up, and which is there for us, and also the waterproofing area, which was not there so much earlier, has now become a significant portion, and it is growing at a rapid pace. So that's the other growth opportunity which is there, opening up for the paint industry at large, and that's something which we are also very serious about. So these are the three things which are happening. Fourth, of course, is the infrastructure category, where we are the leader in the industrial protective coatings. That's gathering momentum. There's a lot of spending from the government on it. and that helps us because we are well placed there to gain out of this extra spend on the infra.
All right. Abhijit, appreciate your time and so good to have you on ET Now. Thank you for joining us.
Thank you.
What a lovely day. I mean, the color green is the most lovely color to have on a Friday morning. Berger Paints, well, I can tell you green is not that number one selling color, but the color of green on the screen today is very, very, prominent. Apollo Hospitals is below the 200 DMA. I want to look at Yes Bank because we did get a yes and a no from SBI that eventually they will look at selling the stake in Yes Bank. But when, I don't think it is something which is decided. Yes Bank on your screen, 15 rupees. It's a stock which has not participated. The day belongs to large cap stocks, guys. Reliance, big one. That's the big one. Let's take a break with the news that Reliance is almost up 3%.
Well, all thanks to Reliance, which is the massive most contributor to today's move along with ICICI Bank. These two stocks really holding the ship up for the markets right now. And what an excellent market breadth as well we have at our hands. Good time as any to then get back to our chartists and find out what stocks they are recommending in trade and what are the chart busters that they are spotting. Kunal, you go first. What's on the charts?
So, Aisha, it's a very interesting indicator. That's the CMB indicator. We call it as a cumulative market breadth indicator. It's an indicator which I've devised. Looking at the structure of how the overall market, that's the entire NSE, pans out with respect to the performance as well as the benchmark Nifty performance for itself. Now, this is the last 1 year of data for the CMB indicator versus the Nifty. This brown line, as you can see, is the Nifty charts, and these bars are the CMB indicator. Now, the interesting bit is that whenever the CMB indicator enters into this zone of -10, -11, that's where the market gets into an oversold territory. So, this was, I think, in March 2022, where the index had hit levels of 16,500. First attempt, the index went into a bounce. The second attempt, at a higher levels, the index formed a major bottom for itself, and we went to a strong rally. This was in the month of June, July 2022, where the CMB indicator first entered into the oversold territory. The Nifty went into a process of a bounce, and the second attempt for the CMB indicator below the 12 is where we saw the index going to a downward trend. Now, the reason why I'm flagging of this is because in the last 1 month, in the month of February, the CMB indicator had first signaled a sign of a bottom. There was a rally of almost 500, 600 points on the Nifty. And the second attempt is where we are, the CMB indicator below the -10, -12 mark. And the index is now showing signs of a possible bottom formation. So even if you look at the last 2 or 3 attempts, it indicates that there could be at least a decent bounce, if not a major rally, which could be at play for the indices.
Right. Naresh, Indian hotels on your radar, right?
Yeah, so, so looking at the stock for an eventual breakout going forward, the stock after making the huge move in 2021-22 has gone into a sideways consolidation. The base is clear at 290 and 330 is the upper band of the resistance. Classical consolidation going on. Eventually it should break out about 330 and go towards 400 is the view. So it's an accumulated current levels, preempting the eventual breakout which would happen in the short to medium term. So buy at 305 to 325 zone with a stop loss at 300 and a target price of 400.
Okay, let's get in some stock-specific ideas as well. Kunal, what's on your recommendation list?
So ICICI Bank is now a confirmed breakout candidate above the 870 plus mark. So assuming if the stock closes above this levels, we could expect a stronger up move for the stock. 900 could be an immediate psychological breakout target for the stock. 855 is a stop loss. And the second would be buy on Page Industries, again a possible turnaround candidate. Now coming very close towards breaking past above the 50-day moving average. Buy with a target of 40,000, stop loss at 37,000.
Right. And Naresh, on your stock list?
First is an SBI with a stop loss at 515 and a target price of 550. Second is a buy on BEL, finally a short-term breakout done about 96, 97 levels. Very strong volumes today. This could lead to a follow-up going forward towards 110, a stop loss at 94.
Okay, let's welcome on board then Rajdeep Gupta, the founder and group CEO at Route Mobile, joining in the show right now. Rajdeep, hi, good morning. Good to have you today on ET Now. First, let's talk about the recently signed contract with Robi Axiata. Just wanted to understand what's the contract value and what's the time period over which you would execute it.
Good morning. I think Robbie Exeta is a complete call center setup we have done for a UCaaS solution for voice. It's a 3-year contract and it's a 350-seater kind of a setup we have done for Robbie Exeta. It's one of our first installation with operator on voice platform. And we are very bullish about this product. And I think there are multiple operators who are looking out for this kind of product to be launched. So we are, end of the day, we are trying to solve their customer service part which requires to have a lot of call center capabilities through the cloud telephony, and that's exactly what we have done for them, and it's a 3-year contract.
Margins are you expecting?
I think we're expecting about $3 to $4 million. It's a very not big contract, but based on our first project with operator, I think this could be one of the use cases we can use for multiple operators. So it's about $3 million deal.
Why would you enter into voice? I mean, voice is supposed to be taken over by chat, GTP and AI. I mean, voice is old school.
Not exactly, Nikunj. If you see voice, the current use cases for voice in various enterprise segment is increasing day by day. You know, like we still have cloud telephony as a customer support is still there. You know, like and voice. I think Chat GPT has a different use case as compared to voice cloud telephony. So we believe that in coming years down the line, cloud telephony will play a critical role in CPaaS company like Root Mobile. And when you talk about CPaaS company like a Root Mobile, I think you need to have an offering for voice as a part of your offering. And that is the reason we build this product in-house. And I think we believe that in coming years down the line, it will add more value to Root Mobile.
Okay. Now you've had an excellent FY23. What you projected, you've achieved in first 9 months. It's the last day of FY23. Tell us about FY24 then.
Sure, Nikunj. I think we have promised to the market that about 70% growth this financial year. And we stick to our growth trajectory and our guidance to the market. Probably we may overachieve our guidance as well. You know, like I don't know the numbers, but I think what guidance we have given to the market, I think we are definitely going to achieve that. And if we talk about FY24, there are different lever which is going to play in our favor. Some of the advantage we are going to see because of price increase in India, which is happening in April. Probably we have a new setup in Mexico, Peru, and Saudi Arabia. We believe Indonesia is going to play a very critical role for our overall growth. And 24 is very exciting for Root Mobile because multiple products which we have built in last few years are going to contribute overall in our revenue and margin.
Is there any correlation with what is happening in the fintech world or the consumer tech world or the startup world or even now the big tech world? Because all we're getting in media is the following headlines. Big companies are not hiring, small companies are firing, startups are not getting cash, IT outsourcing is decreasing. There is a lot of messy headlines out there.
So Nikunj, we are a bootstrap company. I bootstrapped this company with just $2,000. You know, that is the only investment we have made around 19 years back. And once you are a bootstrap founder and you exactly know how to scale. So I believe in a very simple funda of 3S, which is scale sensibly to sustain. And I think that's exactly what we have done. In fact, we are not firing people, we are hiring people all across the globe. And I think we are almost now 750 people all across the globe, and we are planning to hire another 100 people very soon. So I know there are lots of things happening in the tech world but fintech world, but we as a company, as a CPaaS company, we are looking out to hire more 100 people in next year for sure.
So FY24, if one has to understand that the base effect which you referred to, what could be the impact of this base effect then?
So I see that one area of iteration is definitely in last FY23. If you see, the kind of iteration rate all IT companies have faced. Probably 24 we might not have that because there are lots of firing happening at top level companies, and there are influx of talent available now as we had a challenge in 23. 24 would be a good for us to hire a good talent at good price also. So that's one thing. Apart from that, I think I can talk about the industry, which is more about the digital penetration. If you talk, or digital adoption, if you talk, we are a champions of emerging market, and all the emerging markets are going to have a multifold digital transaction or digital adoption. And we are very bullish about the market which we work on, including the LATAM now. So I really don't want to comment on the base effect, but we are very bullish about what we can achieve in next year.
So let's be specific here. Acquisitions, MR messaging, ManVision, they've been boosting growth. So will this be again part of a core strategy? I mean, I'm using a parallel here. Let's say Wipro. Wipro had a core strategy of growing with acquisition. Infosys never had a core strategy, or TCS never had a core strategy of growing by acquisition. What will be a core strategy then?
So I think last few years, Nikunj, if you see, we acquired a few companies, and the idea of going global, if you really want to serve customer globally and you want to penetrate to the local enterprise market, you need to have a local presence. Setting up a sales office from India to Latin America in Colombia or Mexico is impossible to have that. And if you really want to gain traction in those markets, the acquisition is the only option you have. And we exactly did the same thing for Europe. With the same option we had, like, so we acquired Mr. Messaging in Europe and Messavian in Colombia. So I think we believe the growth, if we really want to, because we already have the stack, the platform has been built in India. We need more market to sell those channel of communication in various markets. And our story is very simple. Like, if we really need to acquire some market, we don't want to just set up our office salespeople, sending salespeople from India to that market. It's better to look for a smaller company or large company, a company who's stable, who's doing good, profitable, and acquire those companies and be a part of them and try to support them in a multiple way so that they can use our tech platform to start selling to these channels to their existing customers.
All right, Deep, appreciate your time. So glad you could join us, and thank you for your quick analysis. Let's take a break. When we come back, we'll talk about the SBI interview once again, because the SBI chairman today has really communicated a lot of interesting things. First, credit growth will not come down despite the high base effect. NPA cycle is not a problem. Home loan rates will remain low, very important. And fourth is that they do not expect a problem whatsoever in terms of maintaining the Adani Group exposure.